This video is an Uncovered Japan company research report on Watami, ticker 7522. It is a Japanese food company whose most important business is not the izakaya chain many investors remember, but home-delivered meals for older people. That stable delivery cash engine now sits alongside a recovering restaurant estate, a growing subway footprint, and a substantial cash balance. The starting snapshot is straightforward. On the report's FY26 figures, Watami traded at about 10.2 times earnings and held roughly 21.3 billion yen of net cash. Meal delivery contributed 44% of sales. The scorecard is 14 out of 20. The value case and aging population tailwind are tangible, while thin liquidity, governance, and unproven margin improvement keep the story balanced. Watami's core service is a subscription-style meal delivery operation for elderly customers. Prepared meals are distributed through 506 local depots, with roughly 7,000 delivery staff. The handoff matters. For families, it can pair nutrition and convenience with the reassurance that someone is regularly checking in. That physical, trust-based network is the clearest reason this is more than a generic frozen food business. The recovery is real. Revenue rose from 64.4 billion yen in FY22 to 93.3 billion in FY26, finally above the pre-COVID level. Operating profit swung from a 3.6 billion yen loss to a 4.8 billion yen profit. But the report makes an important distinction. Much of the margin improvement came from fixed cost dilution as sales returned, so the easy operating leverage gain is largely behind the company. Segment mix explains both the resilience and the valuation. Meal delivery generated 44% of sales and a 10.5% operating margin in FY26. Domestic restaurants produced almost as much revenue, at 40% of sales, but only a 6% margin. This stable, lower-growth delivery profit pool is why the market tends to value Watami more like a meal delivery operator than a fast-growing restaurant chain. Net income is less clean than operating profit. FY26 ordinary profit benefited from a 908 million yen foreign exchange gain, while restaurant site impairments recur as Watami reshapes its estate. The report therefore anchors underlying performance on the 4.8 billion yen operating profit figure. Investors should watch whether the restaurant portfolio can improve without repeatedly consuming too much of that operating progress. Cash generation is a quiet strength. FY26 operating cash flow reached 7.6 billion yen, even while investing outflows supported growth capex. Cash and deposits were 43.6 billion yen, against 29 billion of interest-bearing debt, leaving about 21.3 billion yen of net cash. That flexibility can fund subway expansion, overseas investment, shareholder distributions, or a potential preferred stock redemption. The competitive advantage is not one restaurant brand or a software platform. It is a shared food and distribution system. Watami combines procurement, farms, central kitchen capacity, logistics, and the delivery network across its restaurant and meal delivery channels. The company says it has led Japan's senior meal delivery market for 14 consecutive years. Competition from frozen meals is real, but rebuilding a nationwide human delivery relationship would take time and capital. Management's strategy is to use meal delivery as the cash base while reducing reliance on izakaya through subway, yakiniku, and overseas expansion. The subway business had expanded to about 200 stores by May 2025. The execution test is margin, not merely footprint. Domestic restaurants still earn less than delivery, and overseas represented 12% of sales, but only a 0.5% margin. The Onigiri investment in the United States is early-stage evidence of that overseas ambition. At about 10 times earnings, Watami trades near the low end of its post-COVID valuation range. It is not obviously cheap against a direct meal delivery peer, but the enterprise value lens is more interesting because net cash is worth more than half the market capitalization in the report. On that basis, estimated EV to EBITDA is only around 4 to 5 times, leaving the restaurant recovery and overseas optionality as the variables the market is still reluctant to pay for. The report's 3-year scenarios are the author's estimates, not company guidance or investment advice. They range from roughly minus 68% in the bear case to plus 34% in the base case and plus 178% in the bull case. The real swing factors are clear: restaurant margin convergence, overseas profitability, wage and food cost inflation, and whether the valuation discount ever closes. Watami is a two-engine recovery story. A defensible senior meal delivery franchise provides cash and stability, while Subway, restaurant formats, and overseas create optionality. The balance sheet offers real protection, but the discount has reasons: rising costs, thin liquidity, founder concentration, and a preferred stock burden. The key question is whether growth becomes margin. This is research for education, not a recommendation to buy or sell any security. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.